Hey, this is Bert Salazar. I hope that you and your family are doing well. I've been doing a number of videos on the versatility of life insurance contracts, not only from a taxable standpoint, but also from a death benefit perspective. And most important, I've done videos on, what are the different types of life insurance contracts that are available in the marketplace and the taxation of each and every one of those contracts and so forth. So what I'm going to do today is I'm just going to take a few minutes of your time and talk to you as to how to properly fund a life insurance contract or 7702 contract. And there are many ways to do so. And whenever I'm asked the question, Bert, what would be the best way to fund a contract? The answer is always the same. It really depends on what it is that you, as an insured and as the owner of the contract, what it is that you have in mind as far as the investment portion of the contract. Because you can buy a life insurance contract just for the death benefit only and just use it as a legacy replacement, or I want to replace all the mistakes that I've ever done in it from a financial standpoint in life at the time of death. So therefore, the only thing you're interested in doing in that type of contract is to buy the largest amount of guaranteed death benefit that you can purchase for the least amount of premium. So once again, you want the largest death benefit for the least amount of premium. Now if you're only going to use that contract for a number of years, then you can buy some term insurance for, let's say, a guarantee of 20, 25, 30 years. But if you need that contract to be there for your time of death, and because of the fact that you don't know when the time of death is going to come to you, because you can have a short life, you can live an average life, or you can live a long life, then you want to make certain that you have a guaranteed permanent contract. Now, for those type of contracts where my clients are only interested in the death benefit that would be readily available, like money in escrow, and escrow closes the day you die, then I would probably use a guaranteed universal life contract, because the contract features provide for guarantees that you're not going to find in some of the other contracts. Most important, the premium is going to be the lowest for a guaranteed contract, because you're only buying premium to mortality, premium to the day that you die. Now, if you're 50 years of age, you can buy an age 90 mortality contract. So at the age of 90, the contract is going to die whether you're alive or not. Now, obviously, if you die, the contract is going to pay the death benefit, but you can buy a guaranteed universal life contract to age 95, age 100, 105, age 124, 121, if you so desire. Remember that the longer the guaranteed premium, the guaranteed period, the higher the premium that is going to be required on a guaranteed basis. So if you're going to buy the contract just primarily as a death benefit only contract, or if you're going to use it as a pension maximization contract, where you're going to start taking principal and interest of every asset that you have in retirement, and then use that death benefit to replace that cash value and those retirement assets that you took while you were alive at the time that you died, and then there would be no money left for your surviving spouse into traditional retirement accounts, then the death benefit proceed would step in, fill in your shoes, and kind of replace all those assets that both you and your spouse used while you're alive. And then at the time of death, then it doesn't matter whether you pull principal out and you don't have that much principal left in those retirement accounts. That tax-free death benefit would replace whatever you have there, and now your surviving spouse can pick and choose what it is that he or she would want to do with those assets from a retirement perspective. So that's one area that you can purchase. Now, a number of my clients also purchase guaranteed universal life contracts in order to also fund the potential liabilities of a long-term care. Many of the new contracts that are sold now in the marketplace provide for long-term care riders like chronic illness, terminal illness, and critical illness, that if you become disabled and you cannot perform 2 of the 6 activities of daily living under a qualified long-term care program, then you can actually invade the death benefit while you're alive, and it will provide a living benefit to help you offset all of those additional expenses that come with a long-term care necessity. But on the other hand, I have a number of my clients that just want to use a 7702 plan as a supplemental retirement plan. Remember, one of the best features in a 7702 plan is that it's part of the tax-free bucket under the IRS code. And under that tax-free bucket, you have your Roth IRAs, you have your Roth 401ks, you have your municipal bonds, and then you have your 7702 plans. But if what you're trying to do is generate the most amount of contributions and have the most amount of the contributions to this 7702 plan / life insurance plan, and use those contributions as a supplemental retirement plan at some point in time in the future, then you would want to do a totally different contribution than the one I talked about a few minutes ago when we were talking about legacy funding. So in this type of contract, instead of trying to purchase the most amount of death benefit for the least amount of premium, I want to do an inversion. I want to buy the lowest possible death benefit for the most amount of premium that I can put into the contract. Now, always remember that in a life insurance contract, the insurance company is going to determine the minimum premium. The IRS is going to determine the maximum premium that you can fund a contract on any given year. And then I, as your tax planner and retirement strategist, will choose with you the optimum premium into the contract. So if you say to me, Bert, I would like to, fund a supplemental retirement plan for me and my family, and I want to fund it with $25,000 a year, because I'm already maxed out in my 401ks or my Roth IRAs, my Roth 401ks, and I need an additional place where I can park money that will grow tax deferred, that would be creditor protected, and also that would allow me to take money out at any point in time under any circumstances. Then my due diligence would be is if the maximum that you want to put into the contract is $25,000, and that would be the amount that you actually have a commitment to fund, then I would lower the death benefit in the contract just enough or just barely to the point that would allow for a maximum contribution of $25,000, or perhaps I'll go a little bit higher and buffer it a little bit, maybe 27, 28,000, in case that you may want to fund a little bit more from one year to the next. What does that do to the contract? Well, it's totally different than the previous example, because in this example, we're using the lowest death benefit that has the lowest internal cost, and we're overfunding the contract because we want to build and increase the cash account so that later on we can use it as a supplemental retirement plan once we retire. So therefore, there's going to be a faster growth of cash values in the contract that is going to emulate anything that you can do from a retirement standpoint anywhere else in the marketplace. And it'll come with a death benefit, and it'll also come with the long-term care riders similar to the ones that I talked about, but not to the same level, because obviously the death benefit would be smaller than in the previous example. Now, why would that be a good thing for you? Well, number one, like I said, 7702 plans provide a tremendous amount of flexibility. It is probably the most flexible and enjoy the most amount of benefits under the IRS code. Why is that? Well, you can pretty much put as much money as you want into a contract, even after the TAMRA Act of 1988, because if you want to fund it with $100,000 a year, then all we need to do is buy enough death benefit to accommodate for that $100,000 of premium. And if it's $50,000, we'll do it accordingly. But it allows you to fund it to the level that you so desire to fund it to. Most important, the money is going to grow tax deferred. You're going to be able to pull the money out prior to age 59 and a half without having to pay any taxes or penalties. You don't have to worry about the old 70 and a half rule or the new age 72 rule, in which at that point in time, if you're in a traditional tax deferred account like a 401k or an IRA, you have to start taking required minimum distributions, not in a 7702 plan. So you can actually allow that money to continue to grow on a tax preferred basis past the age of 70 and a half or 72, depending on your personal circumstances, and allow that money to continue to grow. As a matter of fact, you don't have to take the growth of that money inside of that account ever if you don't want to. Because upon your death, all of that cash value and all of that death benefit that has been building up for many, many years is going to go tax-free to your beneficiaries anyways. So the flexibility that you have with a 7702 plan is incredible. Also, when it comes time to take distribution out of a 7702 plan, instead of being a LIFO, where it's life in and first out, like in traditional annuities, non-qualified annuities, or life insurance contracts that are modified endowment contracts. If you want to learn more about it, check out my previous video on that. But if this is a well-structured supplemental retirement plan, then what you would do is at time of retirement, you're going to start taking the money out on a FIFO, first in, first out, meaning under the IRS code, you're going to take money out every single year if you so desire, up to the cost basis in the contract. And the cost basis is the amount of premium that you put into the contract on an after-tax basis. And then obviously the insurance company will calculate what your cost basis is from one year to the next. And then at the point in time that you actually get to the growth portion of the contract, that for many years has been growing now on a tax-deferred basis, then the IRS gives you an option that it doesn't give anyone else or any other product in the United States financial services arsenal, which is the ability to either take that growth and pay taxes based on whatever your tax bracket may be at that point in time. If it's very, very low, that may make sense for you. Just take the withdrawal and pay the tax. Or you can actually switch to loans where you now have all that growth, that instead of you taking directly the money from your account, you're going to borrow that money from the insurance company, and the insurance company is going to give it to you depending on how you want that distribution to be made, either on a monthly, quarterly, semi-annually, or annual basis. And also you can pick and choose the amounts, and you can decide, well, give me so much one year, don't give me anything the following year. And then you switch to loans, and then that way, because it is a loan, it is non-reportable under the IRS code when you file your income taxes. Now, you're going to have to pay a small interest fee to the insurance company for the lending of that money to you, and they in turn are going to place a collateral or collateral assignment on your contract to make certain that, you know, if you cancel the contract, that they can recover that loan that they gave you. The loan, you don't have to pay it back if you don't want to. You can pay it back at death. So at death, whatever money you borrowed will be deducted from the ultimate death benefit, and then the rest will go tax-free to your beneficiaries. I also have a number of clients that when they do the borrowing, they just pay the interest. Every year on that borrowing could be just a 1% interest rate. And then that way the cost of that loan doesn't increase, but it does give a lot of my more wealthy clients and my small business clients and my professional clients the ability to overfund a 7702 contract to the max, more so that they could do in any other type of qualified plan, and be able to use it as a supplemental retirement plan whenever they deem necessary, and obviously have the control, the care, custody, and control of the assets that would not be non-reportable and not reportable to the IRS from a taxable standpoint. So if you truly understand the features of how to fund a life insurance contract or 7702 plan, and if you understand the taxation and the versatility of those features inside of those contracts, you would be looking at an opportunity to at least start with a 7702 plan for you and your family in place as soon as you possibly could. So those are just some ideas that I have for you. There are many other variations. Sometimes you can do a combination of both. You can do not a supplemental retirement plan per se, but you can increase the death benefit so you'll emulate what a supplemental retirement plan would do for you, but also with a death benefit maximization would do for you as well, and combine both into a straddle. And then you can purchase any type of contract. Sometimes I use 1 or 2 contracts for my clients, depending on what it is that they're looking to do with that contract at any given point in time in the future. So always remember that if you want to pick my brain about anything, feel free to give me a call, area code 786-766-1042. You can also send me an email, Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for each and every one of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks very much for giving me a few minutes of your time, and I'll talk to you soon. Take care. Have a great day.